We're going to go ahead and get started because we have a full day today, and I don't want to cut into Tanya's time because I know she has a full presentation to give you. My name is Phyllis Wellborn. I am a Senior Benefits Specialist here at headquarters in the Benefits Retirement Unit, and today is the final day of our Financial Literacy Month. So thank you all for supporting us throughout the month of April and here for today. Today we have a full schedule. Our Social Security presentation is from 9:30 to 10:45. Then from 11 to 12, we have Medicare. We will break for lunch. We'll return back here at 1 o'clock. And then from 1 to 3:30, your benefits unit, my unit, we will be doing a presentation on your benefits. This is not, the presentation this afternoon is not just for retirees or mid-career. This is for all employees, whether you're first coming on board or you're getting ready to go out the door. The afternoon presentation by our unit will apply to all. So thank you again for your support. We are live streaming today, and so for those of you who are watching by video cast, welcome. And if you have any questions out in video land, then you can send an email to my email address. It should be available to you, and we will take your questions that away. So what I would like to do now is introduce to you Tanya Farrell Johnson. She is a public affairs specialist with the Social Security Administration. And Tanya, I will turn it over to you.
All right, good morning. Can you hear me? Can you hear me? All right, well, good morning. I am Tanya Farrell Johnson. I'm the lead public affairs specialist with the Social Security Administration here in the DC metro area. I'm going to spend a little time with you guys talking about some of our benefits, how you become entitled, those types of things. First slide has my email address. I put that on there for a reason. I want you to use it. If for some reason you have a question following the event or something you don't want to share, or I have to leave and you don't get to me, please do not hesitate to email me your question. It takes me a couple of minutes to respond versus you spending a couple of hours in one of our offices to get that question answered, okay? If you will please hold questions until after the presentation. I am going to hang around. I'm actually going to stay for the Medicare portion. I normally cover Medicare, but since Medicare is going to be here, they're going to tell me some things I don't know. So I will be here following if you have questions after the presentation. First few slides are just informational. Social Security picked up a slogan of sorts a few years ago. We are now Social Security with you through life's journey, securing today and tomorrow. Literally and figuratively, Social Security is with you throughout life's journey. We're there when that newborn needs a Social Security number. We're there when you start that first job and you pay those FICA taxes. We're there when you marry. Should you choose to change your name, you've got to come and see us. We're there at this point in our lives when we're thinking about retirement, and we pay those retirement and spousal benefits. And we're there if something catastrophic should happen and you need one of our disability programs, Social Security disability or supplemental security income. And we're there should you lose a loved one, and we pay those survivors benefits and that lump sum death payment. So literally and figuratively, Social Security is with you throughout life's journey. Your Social Security retirement income or benefit was never intended to replace your pre-retirement income. On average, your Social Security retirement benefit replaces about 40% of your pre-retirement income. So it's very important that you have these other things. Any other incomes, your pensions, your savings, your investments, your children, whatever it is that's going to get you to living the life you want to live once you start working. We do like to consider ourselves the foundation of your retirement. You've paid in over the years. We're there for you once you reach the age of retirement. As of December 2018, there were over 174 million workers paying into Social Security, meaning FICA taxes were being withheld from over 174 million workers. About 94% of those workers are going to be eligible for a benefit at some point. The reason that's not 100 is some people are going to die before they become eligible. They've paid in, but they're not going to be able to receive the benefit because they'll die before they reach the age. Some people are going to work and pay in enough, but they're eligible for a non-covered pension, i.e. civil service pension, and we may totally offset their Social Security, meaning they won't get a benefit from Social Security. And then we have a group of alien who pay into the system, but because of their alien status, they're not eligible to receive the benefit. So we have the 174 million that are paying in, but not everyone is going to be eligible for the benefit. Also, as of December of 18, there were over 43 million workers receiving over $63 billion per month in Social Security retirement benefit. In addition to those workers, we paid an additional 3 million dependents of those workers, an additional $2.3 billion per month in benefits. Now, the earliest that you can receive Social Security retirement benefit is age 62. Social Security benefits are paid a month behind. So the check for May comes in June, the check for June comes in July, so on and so forth. The reason for that is you have to live throughout the entire month to be eligible for the benefit. So if an individual passes, what does May have, 31 days? 31 days of May? Passes May 31st at 11:59. If that's the time that's on the death certificate, that individual is not entitled to the benefit for May that would come in June. That benefit would have to be returned to the agency. Also, all Social Security checks used to be paper, and they used to all go out on the 3rd of each month. Well, that became a hardship for the Social Security Administration having to pay that postage. It also became a hardship for the Postal Service having to deliver those millions of checks we just talked about all on one day. So now your Social Security retirement check is cycled. Your pay cycle depends upon your date of birth. If you were born from the 1st to the 10th of a month, your checks will hit the bank. Oh yeah, and they have to be direct deposited, right? 1st to the 10th of the month, your checks will hit your bank the 2nd Wednesday of each month. The 11th to the 20th, the 3rd Wednesday. The 21st to the end of the month, the 4th Wednesday. And if you've ever received a notice from Social Security, most of our notices state, if you disagree with our decision, whether it's something good or bad, you have the right to appeal. One of the things you cannot appeal that we are not going to change is your pay cycle. So if you are a 3rd pay cycle person, that is what you will remain for the life of your benefit. Also, if you are filing, let's say you've worked for DEA for as long as you can stand, and at 62, you want your money. We usually have 3 groups of folks. We have those folks that say at 62, I want my benefit, as I don't want to wait, because it's probably not going to be there, right? Then we have those folks that say, I'm going to wait until my full retirement age because I want all of my money. I don't want any reductions. Give me all of mine. And then we have those folks that say, you know, I'm doing pretty well financially. I'm going to wait and get those delayed retirement credits. So I'm going to wait until age 70. Whatever category you fall is fine. It's your personal decision. But let's say you're in that, I want mine at 62. I'm stopping work at 62. I want my Social Security benefit also. The first month that we will entitle you is the first month you're 62 throughout the entire month. So today is May, what's today's date? May 9th. Today is May 9th. If you turn 62 on May the 9th and you want to file for your benefits with age 62, the first month we're going to entitle you is going to be the month of June, because that's the first month you're 62 throughout the entire month, right? With no particular day in June, we're going to pay you effective with the month of June. June's check is going to come in July. Because you were born on the 9th, it's going to be the 2nd Wednesday in July. Okay? Now, one exception to that rule is if you were born on the 1st or the 2nd of a month, we deem you to be born the previous month. No particular date in that month. So if you were born May 1st or May 2nd, we deem you to be born in April. If you're trying to get your benefits effective with the month you turn 62, you can actually have it effective with the month you actually turn 62, which is May, because we actually deem you to be born in April. So the first month you're 62 throughout the entire month is going to be the month of May. May's check is still going to come in June, 2nd Wednesday. All right. Now, if we look at this chart, this is representative of an individual who is entitled to $1,000 per month at their full retirement age, and this individual has a full retirement age of age 66. If you file for your benefits at age 62, you receive about 75% of your unreduced benefit, right? So if this individual is entitled to $1,000 at full retirement age, if they filed at 62, they'd get about $750 per month. If they waited until their full retirement age, they'd get about $1,000. And if they waited until 70, they'd get $1,320. We pay what's called delayed retirement credits. It's 8% for every year beyond your full retirement age that you continue to let us work with your monies. But if you'll notice that with every year, it goes up some. So every month you delay, the benefit is going to go up a little. Now, my job is not to tell you when you should file for your benefit, but to give you some information to help you make an informed decision. So if you look at this example, an individual at age 66 could get $1,000 a month. At age 70, $1,320 a month. Social Security looks at everything in terms of months. So from age 66 to age 70 is 4 years or 48 months. So this individual could have received $48,000 from 66 to 70. How long at a $320 a month difference is it going to take to recover that $48,000? So it's like, at what point is it advantageous to have waited until 70? It's going to take, in this particular example, it's going to take about 12.5 years from age 70 to break even, to then start benefiting from waiting. Okay? So how many folks in here have a My Social Security account? Wonderful. All right. So we used to mail out that earnings statement every year around your birthday. We only mail it out now in very special occasions. The only way now you can check your earnings to make sure they're correct is if you have your My Social Security account. It sits right there. You can check it. But what you can also do is see what you could receive. How much am I going to be able to receive at 62, at my full retirement age, at age 70? And then you can do that same break-even thing. You know, what's the dollar amount difference between this point to this point, and how many years is it going to take me to recover what I missed by waiting? Okay. Having some technical difficulties. Did I do something? All right. Okay.
You can use
Lose the thing here.
the screen.
All right. Okay, now, in order to become eligible for Social Security retirement benefits, you have to earn what we call credits or quarters. You'll hear the words used interchangeably. Every year, Congress sets a dollar amount that a credit is worth. In 2019, it's $1,360. Every year, you can earn up to 4 quarters. Once you've earned $5,440 in 2019, you've gotten your 4 quarters for the year. Does not matter where in the year you earn $5,440. You can earn it all in January. You've got your 4 quarters for the year. The magic number, though, is 40. 40 quarters gets you insured for Social Security retirement benefits. Once you have 40 quarters, we stop counting quarters. No one has 44 quarters. No one has 80 quarters. 40 quarters is the magic number. Once you've gotten your 40 quarters, we are then going to look at your earnings. Let's go back. I'm sorry. Let's go back to this one. We're going to look at your earnings. And I mentioned a little earlier that you need to check your earnings record. Sometimes earnings are missing. Yes, ma'am.
Can I just ask a question about when you were talking about the calculator and figuring out how much time it would take you to make up your wages and stuff?
Mm-hmm.
Does that include reductions for, like on CSRs offset, so I'll have reductions made to that?
Oh, yeah. It's CSR. We're going to talk about, you can't, don't.
Can't use that.
No, it's not going to be accurate because it doesn't take into consideration the offset that we're going to impose. And we're going to talk about that in just a second. Now, we're going to look at your highest 35 years of earnings when we're figuring your benefit. So if you look at your earnings record and there's some earnings missing, let's say you knew you worked in 95, but for some reason 95 shows a 0. And that can happen. No fault of your own, but sometimes an error occurs. All right? So you need to check that earnings record prior to your becoming entitled to or ready to file for the benefit so that it can be corrected and your benefit will be figured accurately. So if you have a 0, say in 95, you know you were working at DEA, and you had some earnings missing. The only way Social Security can correct that for you is if you have a W-2 for those missing earnings or a closed out tax return for those missing earnings. But let's say you don't have those two things. If you were working for the same employer the year before the missing earnings and the year after the missing earnings, we will average those 2 years, the year before and the year after, and give you something there. Something is going to be better than having a 0. And if you find those other things, then we can always correct it. Because when we're looking at your highest 35 years, we're looking at 35 years whether you've worked 35 years or not. So let's say you've only worked 20 years. By the time you're ready to file for your benefits, you've only worked 20 years. 20 years of earnings is enough to get you insured. You can get 4 a year. Normally 10 years get you your 40 quarters. So time of filing, you have 20 years of earnings. We're going to take the 20 you do have and we're going to factor in 15 zeros. And everybody knows what a 0 does to an average. It's going to bring it down. So if you have a 0 someplace there should not be, you want to make sure you get that straightened out, right? So we're going to get your highest 35 years from your earnings history. Before we average them, we're going to index those early years earnings. Usually for most folks, the early years earnings are the lowest earnings. So we're going to index them, meaning we're going to give them current wage value. So in 87, you may have earned $17,000. 2019, once we index it, could be worth $35,000. Okay? So we're going to grab your highest 35. We're going to index those lowest years earnings, and then we're going to average those 35 years. And that gives us your average monthly earnings. Now, the percentages you see here, the 90, the 32, and the 15 are constant. The dollar amounts change each year. So if we were figuring your benefit in 2019, we would take of your average monthly earnings, we take 90% of the first $926. Then we take 32% of any earnings from $926 to $5,583, and then we take 15% of whatever's left. We'd add those 3 totals together, and that gives us what you could receive if you waited until your full retirement age to receive your benefit. Your full retirement age is determined by your year of birth. Right now, full retirement age is maxed at age 67. Anyone born after 1960, full retirement age is 67. So you find your year of birth, and then that second column tells you what your full retirement age is. Now everything, I keep clicking this thing like it's working. Everything that we just walked through as far as how we figure your benefit, you can do manually. We have a publication on our website titled Your Retirement Benefit, How It's Figured. It gives you the indexing factors back to 1937. You would look at your earnings history, write down your actual earnings, multiply it by the indexing factor, add those 35 years, divide by 35, take 90%, 32%, 15%, add those 3 totals. It only gives you what you would receive if you waited until your full retirement age. You can do it. It's very transparent. There's no secret to how your benefit is figured. But I would suggest you use our retirement estimator. Not only will the retirement estimator give you what you can receive at your full retirement age, but it also lets you do what-if scenarios. What if I filed at 63? What if I waited until 67? So it's going to give you more options than that manual, the publication I was just telling you about. What it also will do, if you recall when we used to mail out that earnings statement, if you read, most people didn't read around it. They just wanted to see those numbers. What am I going to get? But if you read around it, it told you that these estimates are based on the fact that you're going to continue working at the rate that you're currently working, right? If you stop working, then this is not going to be accurate, right? So what the retirement estimator will do is it'll allow you to put in zeros. So it's going to ask you to estimate your future earnings. So if you know you're going to, if you're one of those folks that can retire at 56 or something, that's craziness, no. You can retire at 56, and you know that for the next 6 years until you become Social Security retirement eligible, you're not going to work, right? So there are going to be 6 years. Usually what would have been your highest years are going to be zeros. So it'll allow you to put in your projected future earnings so that it can give you a better estimate. Now, if you are an individual who is CSRS or CSRS offset, or you worked for some other entity that did not withhold Social Security taxes, you cannot use the estimator. All right. Also, if you are receiving benefits already, don't know why you would do it because you already know, but it puts it in the slide. If you are receiving Medicare, if you're on Medicare, you can't use it. Pretty much if you have a record with Social Security already, if you're on a record, you can't use the estimator. Okay. But for those of you who can, please take advantage of it. It's about planning. All right. Now, for those folks who are CSRS, prior to 1985, an individual who worked for an entity which did not withhold Social Security taxes, a non-covered entity, could receive that pension and their Social Security retirement without any offset whatsoever. And if you recall on our equation, we take 90%, we take the largest chunk of the smallest dollar amount, right? So those folks who did work for someone who did not withhold Social Security taxes usually work just enough to get those 40 quarters. So their 926 in 2019, we would take 90%, the largest chunk of the smallest contribution. That was considered to be a windfall. And so that windfall was eliminated, thus the windfall elimination provision. So now, instead of those individuals who did work for a non-covered entity being eligible for that 90% of that first part of the equation, we're going to look at how many substantial years an individual worked under Social Security to determine if it's going to be 90% or some other percentage. Okay? And that first part of the equation where that 90% is the only place in the equation that's different for a CSRSer. Okay? So we're going to look at how many substantial years you did work under Social Security. Had to have been at least 10 in order for you to have your 40 quarters. If you don't have your 40 quarters, then it's a non-issue. But if you've gotten your 40 quarters, which means you have at least 10 years covered under Social Security, we're going to look at how many substantial, and I keep saying substantial because there's a difference between substantial years and years. You could have 30 years of work that you paid into Social Security, but maybe only 10 of them are considered substantial. Substantial has a dollar amount, okay? So if in 2009 you earned $17,000, if that $17,000 is one of your highest 35 years, we're going to use that $17,000 in your calculation. But if you were, if you're eligible for a non-covered pension, $17,000 is not enough in 2009 to be considered substantial. It would not be counted as one of your substantial years of earnings for the offset purpose. So let's say you worked and you had 24 years of substantial earnings under Social Security, and you're ready to file for your benefits. Instead of taking 90% of, in 2019, that first 926, we're only going to take 60% of that first 926. The 32 and the 15 percentages are going to stay the same. So the only place that's different, the only place that changes for those folks who are eligible for that non-covered pension is in that first part of the equation. Now, if you are going to be eligible for a non-covered pension and you plan to work beyond your full retirement age, and I know I just said like a few minutes ago, I'm not here to tell you when to file, but if you are going to be eligible for a non-covered pension and you're going to work beyond your full retirement age, it would be to your advantage to file for your Social Security benefit at your full retirement age. And we're going to talk about working in probably the next slide. But once you reach full retirement age, there is no limit for Social Security's purposes. There is no limit to the amount that you can earn. The windfall elimination provision offset only goes into effect when you are eligible for both your non-covered pension and Social Security. So if you're still working, you're not yet eligible for that non-covered pension. So there is no offset. There is no offset until you're eligible for both that non-covered pension and your Social Security. So if you're going to work beyond your full retirement age, you know you're going to get that non-covered pension, and at some point we're going to offset you, then it would be to your advantage to go ahead and file for the Social Security benefit and get your full unreduced, because you're full retirement age, get your full unreduced benefit until you start receiving that pension, and then we would start the offset. This is just a list of some more of the tools or the calculators that we have on our website for you to use for planning purposes. Any tools that we have available, please take advantage of them. I don't know if anyone has visited a Social Security office recently, but the wait times are not the best. So if there's some things that you can take care of online, please take advantage of those things. All right, so now working. You can work and receive your Social Security retirement benefit, but there is a limit to the amount that you can earn. Not the amount that you can work, the amount that you can earn. Every year, Congress sets two annual earnings limits. In 2019, the under full retirement age earnings limit is $17,640. If you are in the year you turn full retirement age, it's a much higher earnings limit, almost $47,000. And the first one, the under full retirement age, is $17,640. If you earn over that limit and you're receiving Social Security retirement benefits, Social Security withholds $1 for every $2 that you earn over that limit. And the way that works is, the way that hopefully it works is, you, let's say, retire May 2019, you sit at home for as long as you can, and then you start going a little stir crazy, and come February of 2020, you decide, I want to do a little something, I got to get out of the house. So you get a job. Hopefully, as soon as you get that job, you contact Social Security and let us know that you're working. What we would then ask you is to give us an estimate of what you will earn for the rest of the year. We need a yearly estimate, because that helps us to determine, or that does determine, how we're going to pay you. All right? So the way it would work is, you contact us February of 2020, say, I'm going back to work, I'm going to earn $21,640. That's $4,000 over the limit. Social Security needs to withhold $1 for every $2. We need to withhold $2,000. Right? Your monthly benefit is $1,500. Social Security does not withhold partial checks. So we're going to withhold 2 of your $1,500 checks to recover $3,000. Right? That's not right. But just so that you know, Social Security is not going to withhold a partial check. It's going to withhold 2 of your full checks and then reimburse you that $1,000 back. So we need to withhold 2 checks. You contact us in February. Social Security does an immediate withholding. So we're going to withhold February's check, which is not set to come until March. Right? So we're going to withhold February's check, and we're going to withhold March's check. We're going to start back paying you with April that you will get in May. Okay? Now, what happens is that's kind of considered a voluntary suspension. You've contacted us because you know that we're going to withhold benefits until we recover what we need to recover. But what happens is, once you reach full retirement age, we're going to refigure your benefit. And for every month that we had to withhold your check or put your benefit in suspense, we're going to kind of give back to you. We're not going to give you back the money we withheld, but we're going to reduce your reductions. All right? Let's say you filed at age 62. Your full retirement age is 66. When we figured your benefit, we reduced your benefit by 48 months. We reduce your benefit for every month you file prior to your full retirement age. Okay? So if you're filing at 62, full retirement age is 66, the original reduction was 48, or 4 years, 48 months. Now, let's say during that 4-year period, there were 10 months based on your work that we had to put your benefit in suspense. There were 10 checks that we had to withhold because of your estimates over that 4-year period. Once you reach full retirement age, we're going to refigure your benefit and reduce your reductions by the number of months we had to have your benefit in suspense. So if you started out originally with 48 reductions, once you reach full retirement age, we're going to take those 10 months that we had your benefit in suspense, and we're going to subtract that from your original reductions. So instead of your ongoing benefit for the rest of your life being based upon a 48-month reduction, it's now going to be based upon a 38-month reduction. The lower the reductions, the higher the benefit. Okay, so you're not getting the money back per se, but your ongoing life benefit is going to be higher. Now, the other scenario is if you don't tell us, if you don't contact us and say, hey, I've gone back to work, what instead happens is we find out when you file your taxes. And instead of us being able to refigure your benefit because we put it in suspense, you're going to get an overpayment notice if you earned over the limit. And then you'll have a federal debt, and no one wants that. All right, so a couple of benefits to working after you start receiving your benefit. One, of course, is if we're able to recomp your benefit and give you that increase once you reach full retirement age. But let's say you were that individual who, when you filed, you only had 20 years of earnings. So we had to factor in 15 zeros. For the next 15 years, any earnings you have is going to cause your benefit to go up because it's going to knock out a zero, right? So if you earn $10,000, it's going to knock out a zero we used in the previous computation. So that's a plus. The other plus, of course, is you're still paying into the trust fund, and we appreciate that. All right. Now, once you reach the year that you turn full retirement age, of course, it's a much higher earnings limit, and then we only withhold $1 for every 3. One of the things you have to think about, depending upon where your full retirement age falls, is that same scenario as when that graph was up and I was saying how long is it going to take you to break even, right? So let's say your full retirement age is 66 and 2 months. That happens to fall in August of 2021, right? August 2021, your full retirement age. In January of 2021, you could receive from Social Security $2,000 a month. August, you could receive $2,100 a month. Do I take my benefit, and you're not going to earn more than, say, 50. By that time, it'll be about $50,000 earnings limit. You're set to make $90,000 for the year, so you know from January through July 31st, you're not going to earn more than $50,000. Because as of the first day of the month you turn for retirement age, there is no longer a limit to the amount that you can earn. All right. So January you could get $2,000. August you could get $2,100. From January through July you could have gotten $14,000. At $100 a month difference, how long is it going to take you to get that $14,000 back? It's going to take about 13 years from your full retirement age. So just something to think about when you're deciding when you're going to file. Again, as of the first day of the month you turn full retirement age, there is no longer a limit to the amount that you can earn. At that point, it's between you and IRS. So in addition to paying you, the worker, we also pay a few categories of dependents on your record. One of those is children. For Social Security's purposes, a child is either your natural, adopted, step, and in some cases, grand. We will pay a grandchild on your record only if both parents are disabled or deceased. All right? A child is going to be under the age of 18. A child is going to be unmarried. If a child is receiving Social Security dependent child's benefits and marries, the benefit stops unless they marry someone who is also disabled. All right. Now, a child is going to be entitled to 50% of your unreduced benefit. So whether you took your benefit early or not, your child is going to be entitled to 50% of the unreduced. So if you have an unreduced benefit amount of $2,000 and you took yours early, so you're getting $1,500, your child is going to be entitled to 50% of the $2,000. So that would be an additional $1,000 coming into the household. We will only pay a child up until 18 unless that child is still in high school full-time. At that point, we can pay up until 19 and 2 months or graduation, whichever comes first. We will also pay a child beyond the age of 18 if that child has been found to be disabled through one of Social Security's disability programs and that disabling condition was found to have occurred prior to the child reaching age 22. They don't have to file before age 22. We just have to determine that their condition began prior to age 22. Okay. In addition to paying the child, we'll also pay a spouse on your record. A spouse is entitled to 50% of your unreduced benefit reduced for their age. So just as we're going to reduce your benefit by the number of months prior to your full retirement age, we're going to reduce the spouses the same way. A spouse has to file on their own record before they can file on your record. A spouse cannot file on your record until you file. Right? A spouse is only going to be entitled to additional benefits on your record if their unreduced benefit amount is less than half of your unreduced benefit amount. So if you have an unreduced benefit amount of $2,000 and your spouse has an unreduced benefit amount of $1,000, is your spouse going to be eligible for any additional benefits on your record? No, it has to be less than half, not half, right? But if you have an unreduced benefit amount of $2,000 and your spouse has an unreduced benefit amount of $500, your spouse is going to be eligible for some additional benefits on your record. The spouse is entitled to the higher of the two benefits. The one benefit is their own, $500. The other benefit is 50% of your unreduced, which is $1,000. They're entitled to the higher of the two, which is that $1,000. 500 of that 1,000 is going to come from their own record, and the other 5 will come from yours. If they're not yet full retirement age, then both those 5s are going to be reduced depending upon their age at the time of filing. All right.
You gotta hold it. Hold it like this here. You to go.
All right. Thank you. Now, in addition to paying your spouse, we also will pay a divorced spouse on your record. In order for a divorced spouse to be eligible on your record, the marriage has to have lasted at least 10 years. You have to have been divorced for at least 2 at the time of filing. The divorced spouse cannot be married at the time of filing. They could have married since you guys divorced, but at the time of filing, they cannot be married. If a divorced spouse begins receiving the benefit and remarries, the benefit stops. We do not have LoJack or anything to find out if a person files for divorce, or remarries, But normally we find out. Somebody tells. And then if it's some time has lapsed, then that creates, of course, an overpayment for that divorced spouse. Now, much of the same requirement, the divorced spouse has to file on their own record before they can file on yours. The divorced spouse is entitled to 50% of your unreduced benefit, reduced for age. The difference with the divorced spouse is the divorced spouse does not have to wait for you to file on your record. Everyone has to be at least 62. So if you had a divorced spouse who, let's say, was a homemaker, already 62, they know you turn 62 next week. They come into the office. One of the few claims we do not have online is the divorced spouse application. You have to come in and still see us. Bring us your marriage certificate and your divorce decree so that we can see that that 10-year duration was met. If it is, and all other requirements are met, we pay that divorced spouse. We do not notify you that someone is now receiving benefits on your record. Now, for every Social Security record, there is what's called a primary insurance amount. That is your unreduced benefit amount, and there's a family maximum. The family maximum is the maximum that we can pay on that record, including what we pay you, right? The divorced spouse is paid outside of that maximum. So the amount that we pay a divorced spouse is not going to affect your benefit amount. It's not going to affect what a current spouse could receive, nor will it affect what any children on your record could receive. So no one we pay on your record is ever going to reduce your benefit. All right, but that divorced spouse is paid out of a special pot of monies. So what we pay that divorced spouse is not going to affect anyone in your household. All right, now let's talk back about, before we go to the survivor benefits, the spousal benefit. If you are eligible for an unreduced benefit amount of $1,000, or your spouse is eligible for $1,000, you're eligible for $2,000, your spouse could not receive off of yours, right? Because it has to be less than half. For a survivor benefit, it just has to be less than. So you may not have been eligible as a spouse, but if something should happen and you're predeceased by your spouse, you need to see if you might be eligible as a widower. This is completely different rules. A widower can file as early as age 60. Spouse in retirement, you have to be at least 62. A widower can receive anywhere from 71.5% of the worker's benefit to 100%, depending upon the widower's age at the time of filing. Now, if you are predeceased by your spouse, still working, you're predeceased by your spouse, once you turn, let's say 63, you decide to stop working, so you're now Social Security retirement eligible and you're eligible for a widower benefit. So you now, as a widower, have an option. You can either take your own and let that widower grow to 70 and get those delayed retirement credits, or you can take that widower benefit, which is probably going to be higher because you can get anywhere from 71.5%, and then let yours continue to grow and get those delayed retirement credits. It does not matter which one you choose. It's your option. What the agency does is, at the point the benefit that you did not select exceeds the one you did, we send you a notice saying, hey, you can now receive a higher benefit on this record. You don't have to switch at that time. We're just letting you know that you can if you want to. There's more money out there should you decide to. You can switch it at whatever point you choose. We have a couple of other survivor benefits. I think most people have heard about the lump sum death payment. It's that one-time $255 that it's been $255 since the beginning of time. It has not changed. We pay it to what we call the living in same household spouse as the primary. If there is no living in same household spouse, we'll pay it to any minor children or any children that are receiving benefits on the record. Those are the only two categories of people that we'll pay that $255 to. But there is a much lesser known benefit, survivor benefit, that we do pay, and it's called the parents' benefit. So more and more we are caring for our parents in their older age. If you are providing at least 50% support, financial support to your parents, and you predecease your parents, and if you die before your parents and you were providing care for them, we will pay your parents a benefit on your record to continue that support. We'll pay 75% of your unreduced benefit to your parent to continue caring for them. Now, of course, you won't be around, so you need to tell someone that Social Security offers this benefit so that some other family member or friend or whomever can come in and apply for that benefit for your parent should you predecease your parent. Okay? And this is just a comparison of the two, the live record and the death record. The live record, everyone has to be at least 62. The death record can start receiving benefits as early as age 60. On the live record, you're entitled to 50%, or the spouse is entitled to 50% of the worker's unreduced benefit reduced for the spouse's age. On the death record, the widower is eligible for anywhere from 71.5% to 100% of the worker's benefit. And those same things apply for a divorced spouse if that 10-year duration of marriage is met. Now, from going around, I have learned that some people put in their divorce decrees that you relinquish all rights to my Social Security, blah, 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 blah. And that's exactly what it is to us. Blah, 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 blah. It means nothing. We're not going to read your divorce decree. We're just looking at the dates to make sure 10 years was met from the marriage to the divorce. So if an individual, even though you all made that agreement, they still decide to come in and file, we're going to pay them if they meet the requirements. So just something I thought you guys should know. I was like, am I just tearing these things up or what?
I think you have to point it toward the.
Okay. So here again, it's just telling you if you're in a widower type situation and you're eligible for your own retirement as well as a widower benefit, We do send that one-time notice to you, letting you know that one has now exceeded the other, but you can switch at whatever point you want. Now, there's another offset that's imposed upon those folks who are going to be eligible for that non-covered pension. It's the government pension offset. And this is the offset that we impose upon you if you're eligible for a widower, or spousal benefit off of someone else's record. So we're not going to be looking at your substantial years under Social Security. We're actually going to then look at your gross monthly pension amount. And we're going to offset anything that you could receive from Social Security by 2/3 of that gross monthly pension. So in this example, an individual is eligible for a $1,200 non-covered pension, 2/3 of which is $800. If you're going to be eligible for a $750 spousal or widower benefit from Social Security, we're going to offset that $750 by $800, which means you would receive nothing from Social Security. If you're eligible for a $1,000 spousal or widower benefit, once we offset that by $800, then you'd be eligible for the $200 from Social Security. There we go. Now, these next two slides, Social Security is the messenger. These are actually IRS slides. We are the messenger in these next two. Now, IRS defines combined income as your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. So when they're determining whether or not your Social Security benefits are going to be taxed, and yes, your Social Security benefits can be taxed, income taxed, they're going to look at your combined income. Now, if you filed an individual tax return and you have combined income of less than $25,000, then nothing that you receive from Social Security will be taxed. If you have combined income that falls between $25,000 and $34,000, up to 50% of what you receive from Social Security could be taxed. Combined income of over $34,000, up to 85% of what you receive from Social Security can be taxed. Similarly, if you file a joint return, if you have combined income of less than $32,000, none of your Social Security benefits will be taxed. $32,000 to $44,000, up to 50%. Combined income of over $44,000, up to 85% of your Social Security benefits can be taxed. The up tos, the could be's, IRS. If you'll notice, I don't know if some of you can see on the bottom here, it says visit irs.gov. I don't know the answers to those questions, but we have to let you know that yes, your Social Security benefits can be taxed. At the end of each year, we send you a 1099 for you to report those earnings. Now, Social Security does not withhold taxes from your benefit unless you ask us to. We can withhold at either a 7, 10, 12, or 22%. You fill out that WV4, let us know what percentage you want us to withhold, and we'll withhold it for you. You can change the percentage, you can stop it as often as you like until you get it to where you need it to be. But it is on a voluntary basis, and we only withhold federal taxes. Look. Come on. Now, I include this life expectancy statistics slide in my presentation because we are, as a folks, just living a little longer. Modern medicine or whatever. We're living a little longer, and Social Security pays you your retirement and your spousal benefit until you are no longer living. Anybody in here know who Ida Mae Fuller is? Ever heard of Ida Mae Fuller? Okay, so Ida Mae was the very first person to receive a Social Security payment. She got her check back in 1937, I think it was. And Ida Mae worked under the new Social Security program for 3 years. In her 3 years working under the new Social Security program, she contributed a total of $25.77 to Social Security. Ida Mae lived to be 100. So based on Ida Mae's $25.77 contribution, she ended up receiving over $25,000 in benefits. And I say that to say that most people will receive what they contribute on average within the first 1 to 5 years of receiving the benefit. But the benefits don't stop. We continue to pay you again until you are no longer. Now, we have to talk about our future. I wonder if I updated this slide. I did not. Social Security is now, based on that trustee's report from a few weeks ago, Social Security is fully funded now through 2035. So it went up a year. Last year it was 2034. We've been in this situation in the past, and the minds on the Hill came together and everything worked itself out. And we are confident that that's going to happen again prior to 2035. However, if for some reason that does not happen, instead of being able to pay you 100% of whatever you're due based upon the age that you file, we'll now only be able to pay you 80% of, and that percentage went up a little from last year. So we'd only be able to pay you 80% of your benefit. There are 3 service delivery methods for conducting business with Social Security. And I like to say online, online, and online. Please, 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 if you can do it online, if we offer you the capability, please take advantage of it, because again, the wait times are not the best in our field offices. We do have our national 800 number if you want to call and handle some. They can only do certain things. And if you are one of those folks who wants to sit in front of a live person when we're talking about what's going to be happening with you for the rest of your life, we are always going to offer a face-to-face option. Now, we have consolidated some offices here lately, so you may have to travel a little farther for that face-to-face option, but that face-to-face option is always going to be available to you. This is a snapshot of our homepage. Those things that we find that folks used most often, we put on the forefront that if you don't yet have your My Social Security account, that sits right there in the lower left-hand corner. If you have a My Social Security account, you can now order a replacement Social Security card online. That is a replacement. If you're trying to change your name or correct a date of birth, you cannot do that online. You still have to come and see us and provide us proof to support those changes. But if it's just a case of I lost it, or I washed it, or I laminated it, if you have your My Social Security account, you can do that online. Don't have to come into the office. That retirement estimator is right there, and then the benefits, if you want to file, are right there for you. Now, for those of you who do have, maybe I need to tilt my head this way, who do have your My Social Security account, or for those of you who don't have your My Social Security account, one of the biggest reasons that we have found for you to enroll in a My Social Security account is so that no one else can enroll in one for you. We ask what we call out-of-wallet questions. We get these questions from Experian, so they change every day, and we don't control them. Experian does. And it asks those questions like, what street did you live on as a child? Or who did you have a mortgage with? Or those types of things. And what's been found, agency has never been breached, but we have had some fraud-related issues with our My Social Security accounts. And what we have found is that family members know the answers to those questions as well. So family members are opening My Social Security accounts for their elderly family members who have not yet opened one. And one of the things that you can do with your My Social Security account is establish and change direct deposit. So they were having benefits, routed to their own banks. So if for no other reason, go ahead and set up your account so that no one else can do one on your behalf. We have a tool on our website called Ask for a Speaker. What most often happens, especially in the DC area, especially with the federal agencies, I get requests either from my being here before, or some human resources person, benefits person has reached out to the agency, and it trickles down to me because I do DC. What we really want to reach, and we appreciate that, we love coming out and speaking with you guys and sharing this information, but as we talked about early on, everybody is in some way affected by Social Security. Everyone needs some message from Social Security. So we want to help reach out, or we want to reach out to those folks who don't have that benefits person that's setting them up for. So we're actually eliciting you to be to work for the agency for a second. If you know of anyone who needs this message, we will go to your churches, we'll go to your schools, we'll go to your civic organizations, we'll go to your fairs, we'll go to pretty much anywhere short of your homes. We're not coming to your house, but we'll go anywhere, and it's a free service. There's no charge. Everyone needs this message. Everyone is affected. So if you know of any organization, anyone who needs this message, please visit our Ask for a Speaker. It asks the who, what, when, where, and what you want us to talk about. What aspect of Social Security do you want covered? And wherever the location, it trickles down to the public affairs specialist that services that particular area. Just a list of things that you can do if you have your My Social Security account. If you're receiving benefits, you can, again, order your replacement Social Security card, get proof of the benefit you're receiving, change your address, change your phone number, change your direct deposit, get replacement 1099s. If you're not yet receiving benefits, you can still get your replacement Social Security card, get an estimate of what your benefits would be. This last bullet is the one that I like for folks to do. It's the estimated Social Security and Medicare taxes that you've paid. I like for folks to go and see exactly what you have contributed. Find out what you have actually contributed to the trust fund, and then look at what you're going to receive from the agency, and you know you're going to live a long life, and just see just how wonderful an insurance program this is. And I think that is my last slide. So if we got about what, 15 minutes? 15 minutes? Okay. Any questions? They've got mics. I think they're trying to get to you guys so everyone can hear.
Yeah, hold on if you have a question for the mic, because we want the folks out in the field to hear your question.
Yeah, that's it.
Good morning. Can you go back to slide where you said the fund was secure for till 2034?
See, I'm having a hard time with this. It's actually now 2035.
2035?
Yeah.
Can you explain that slide? Because I always see that statement that says you're in that group that's not going to get your full
Oh, where
benefit.
are you seeing that? No, I'm just kidding. So every year, and don't get me going into the technical stuff, we actually have a podcast where our financial folks break that down to where I probably better than I can and should even try to. But for every year, that group of minds comes together and looks at what's currently in the trust fund, and then projects how many people are going to be wanting this benefit in the future. And they crunch, and this is so generic a response. They just crunch the numbers to see how much of this is going to be left at a certain point. And their projection actually went up. I don't know why, but like I said, last year it was projected to 2034. And just 2-3 weeks ago, we had a trustees report that projected it to go up a year, so extended it out to 2035. And instead of the 79% of your benefit, they figured it would be 80%. Again, we are optimistic that before we reach 2035, whatever needs to be done to get everyone who is going to be eligible for the benefit, their 100% will take place. But we have to let you know that should that not happen, it's not going to be 100% of your benefit. And I know a lot of people ask me, is anyone going to be grandfathered in? Is it going to affect people that are already receiving their benefit? I don't know, because we don't really like to think about it too much. Yes, sir.
I want to talk about the spouse benefits.
Yes, sir.
Case. Two questions really, but the same area. She become eligible, I'm still living, I'm drawing 100% of my benefits. Is she able to look at my benefits and say if she's drawing under 50%, she can draw from my benefits and I'm still living?
Okay, so you have a spouse
Uh-huh.
who is entitled to less than half of yours.
That's correct.
Okay. And you are currently receiving yours.
Yes.
You've already filed.
Right.
So yes, your spouse, while you are still living,
Uh-huh.
could receive some additional benefits off of your record. It's
Okay.
not going to affect your benefit. It's just
She doesn't get 100%, she just get a portion of
50.
it?
She's entitled to 50% of your unreduced benefit, reduced for age if she's not yet full retirement age.
Okay, all right. Now, when she's full retirement, you're gonna look at her amount of benefits, right?
We're going to always look at hers. So
Okay.
she's got to file for hers first before
Right.
before we even consider what she can get off of yours. So she files for her own. If she's full retirement age, she'd get her full benefit. But if her full benefit is still less than half of your full benefit, then we're going to pay her the difference, because she's now entitled to the full half.
Okay. Second part question. I pass away. Now you show that she gets like 71% until she reaches like age 66 to get her full benefits. Well, she gets the amount that I was getting since I'm no longer living, or would she just be getting a portion more than what she gets?
Okay. So let's say your spouse is full retirement age when you pass. All right. So she's receiving her own because let's say at the time she wasn't eligible for the spouses.
Correct.
Right. So let's say her benefit was $1,000 on her own,
Right.
and you were eligible for $2,500.
Right.
Right. If you had not filed before you passed, or
No, I've already filed.
You
and
filed.
taken-
Okay.
yeah.
So her portion is going to be based upon what your benefit was. So if you were currently receiving $2,000, she's now going to be eligible for, if she's already full retirement age, 100% of what you were receiving. So she's going to continue to receive that $1,000 from her own, and then another $1,000.
Another $1,000
From yours.
from mine. Okay, that answers my question. Thank you.
You're welcome.
My question is almost related to the survivor benefits. How do you apply for that? This is for my mom.
I'm trying to think. Survivors you can do online. If she's one of those folks that, like I said, we're going to always offer that face-to-face. She just go in. How long has she been widowed?
20 years maybe now?
And she never filed?
No.
Oh, wow.
No, she's just been collecting her own benefits.
Okay, so yes, you definitely need to check to see if she's eligible for some additional
Yeah.
off of his record. The only thing is Social Security is only going to go retro back 6 months.
Okay.
We're not
Well,
going to go
that's
back to
okay,
20
though.
years.
Yeah.
Yeah.
All right. And so maybe online, you said?
Yeah, I would check there. I'm not sure if we offer Survivor
Okay.
online app, but if
Okay.
not, there's always an office somewhere.
Okay, thank you.
You're welcome.
If you're receiving a government pension when you file for Social Security, will your Social Security benefit be reduced?
If you're already receiving a government pension, was it a non-covered government pension?
I'm unsure.
So
'Cause
no Social Security
I've
taxes?
had relatives that've gone through it, then I keep hearing rumors, like I'm under FERS. So I keep hearing that when I retire, I'm not gonna get my full Social Security benefit because I'm receiving a government pension.
So you're under FERS? FERS is not affected by the offset. You would
Okay.
receive your full Social Security benefit and your FERS retirement. Yes,
Okay.
ma'am.
And the other question I have is, will you be penalized if you don't have your full 40 credits before you retire?
If you don't have 40 credits, you don't need to come see us.
No, I'm having this issue because I helped my mother go and file her Social Security, and the office told her, you are receiving less of your benefit because when my mother retired, she knew she didn't have her full 40. And she waited a few years before she actually went back to work. So she's 70 now, and they're telling her, well, you didn't have your full 40 at the time you retired, and you didn't reach it before the full retirement age. Now you're also going to be penalized for that.
Is your mom receiving any type of a non-covered pension?
I believe she is.
Okay. So here's the thing. If you don't have your 40 quarters, pretty much 40 quarters, if you don't have 40 quarters, we're not going to give you anything. You're not going to get anything from Social Security. So what you have to think about is if you have 39 quarters, it's like I'm 1 quarter off, I can earn that $1,300 and get me another quarter. But if you're going to be eligible for that non-covered pension, is it worth it going back to work at 70? Because we're still going to offset you. So you still may not receive anything. So it's kind of like do your research before you go back out there just to get that. And then we still offset you to nothing. So it just depends on her situation. I would have to see the numbers. All right. Again, oh, I'm sorry. You have one right here. She's coming over here.
If a person passes away and was receiving Social Security benefits, and the family never informs Social Security that that person has passed, the checks will continue being received at the home?
Well, hopefully not at the home. Hopefully it was going direct deposit. But here, most states in the district have an agreement with the agency. Funeral homes are to report deaths to the agency so that we can stop the benefit. If for some reason, and everybody's seen it on the news, Social Security sometimes pays people well beyond when they've passed. Sometimes that does happen. The agency has a few things in place, but yes, if that individual got through the cracks and no one reported it, no funeral home, no state agency, no family member, and yes, those checks would continue to go. But what we have is certain benefits like Medicare. So if an individual is receiving Medicare and they reach a certain age, Social Security has this thing where every year we look at people's Medicare usage. And if you're over the age of 80 and you've not used your Medicare in over 3 years, it sends up an alert. And so we then have to reach out and try to make contact with that individual to see if they are still alive and that we'll make sure we're not paying someone else the benefit. So there are things in place to try to catch it. It may be some years before it's caught. But yes, to answer your question, that can happen. I think we had one right here.
If you're a CSRS offset and you have worked 2 jobs, so you work for the government, you CSRS offset, but you also have another job, when you reach your retirement age and you collect, I guess, your Social Security benefit, how would that affect the two? Would you get the full retirement, or how would it offset the CSRS offset?
It would depend upon those earnings, those covered earnings, that other job you had, right? It would depend upon, and it goes back to that substantial earnings piece. So if you've had 30 substantial earnings under Social Security, 30 years of substantial earnings under Social Security, and you're eligible for that non-covered pension, that civil service pension, then there is no offset. We're going to figure your benefit just like we would everyone else's. But if you have less than 30, then instead of, like again, on that one part of our equation, instead of taking 90% of that first smallest chunk of our equation, we're going to look at how many years that extra job were substantial.
Okay, so for CSRS offset, would you still, I guess when you actually retire from the government, would that still combine with the Social Security that you've paid, like if you've had your own?
We're going to look at all earnings that you've ever worked under Social Security when we're determining your benefit.
So would you get 2 checks or 1 check? It depends.
You mean as far as your
One
civil
from the
service
government,
pension
right,
and
then
Social
one-
Security?
Yes.
Yeah,
Okay.
you're welcome. We have one back here.
I believe this may fall under spousal benefits, but maybe you can answer that for me. When you reach the full retirement age at 66 or whatever, and you do not want to apply for your Social Security benefits, can you apply off the spouse's benefit?
No.
You
If a
can't?
spouse's is a live record. Both parties are alive.
Okay.
So before you can file on your live spouses, they have to file. Yeah. And you have to file on your own before you can file on theirs. It's only in the widow-widower situation where you have the option to take yours and let theirs grow, or take theirs and let yours grow. But if both parties are still alive, you have to file on your own first. You're welcome.
Okay, I need to know about the divorced spouse.
Okay.
Okay, we're divorced.
Uh-huh.
I'm still working. I just turned 65. So I was told when I got my Medicare card, and and I'm under the old system, so I don't give into Social Security. He was telling me that I could apply for his Social Security at 66.
Are you planning to still be working at 66?
Most likely.
Okay, so yes, just like I was stating earlier when we were talking about the windfall elimination provision, the same applies with the government pension offset, which is what you would be subject to as a spouse, receiving spousal benefits off of his record, divorced spouse's benefits off of his record. The offset does not go into play until you're receiving both the benefits, until you're eligible for your non-covered pension as well as that divorced spouse benefit. So if you are full retirement age, you're still working, we don't care about your earnings at full retirement age, I'd say go ahead and file for that divorced spouse benefit and get the portion, that 50%, because you're full retirement age. So you'd be eligible for 50% of his unreduced benefit, whether he is filed or not. You don't have to wait for him to file as a divorced spouse.
Or remarried?
Are you remarried?
No, he is, not
Oh,
me.
that does not matter.
Okay, good.
As long as you're not remarried. No, he is not notified. No, ma'am.
So same scenario, but you're not working at age 66, full
Okay.
retirement age.
If you're not working, it doesn't matter. I was just saying if you're still working, you might as well get the benefit. If you're not working, you can still get the benefit.
Okay, and that benefit is, so like if the ex-spouse waited until age 70 to draw benefits, and I'm going to wait until 66 to be the full retirement age to get the full 50%.
Okay.
So the calculation would be what I'd get at 66 compared to what they'd get at 70?
No, ma'am. So the delayed retirement credits are only paid to the individual, to the worker, and to widower, not spouse. So if you filed at age 66, at your full retirement age, and if he's already 70, getting his benefit based on delayed retirement credits, your 50% is going to be based upon what he could have gotten at his full retirement age, his unreduced benefit. You don't get credit of that 8% that he gained to age 70.
Oh, by waiting?
Yeah.
Okay. So they're going to compare both of us at full retirement age?
Yes,
Is that
ma'am.
what you're saying? To see if half of his is more than what I'd get?
Yes, ma'am.
Okay.
Now, if he should pass, then you would be based upon his age 70, because a widower gets benefit of age 70. Okay?
I have a question.
Yes, ma'am.
If my Social Security benefit is higher than my spouse's and he predeceases me, when I'm ready for Social Security, I'll draw my Social Security based on, because mine's higher. And he has a surviving parent. Will that surviving parent be able to apply on his Social Security?
Okay, so the only way the surviving parent can receive the benefit is if he were providing 50% care for the parent prior to his passing.
Okay, and that's happened. Okay, so say like his mom lives with us, so if my husband predeceases me, then she can apply on his benefit? Mm-hmm. I don't want that to happen, but I was just checking.
Yes, ma'am.
My question, if you retire prior to 62 at first,
Mm-hmm.
and we take the first annuity with supplement, does that affect the Social Security when the person goes to claim Social Security? Does the Social Security get reduced?
No.
No?
They're separate payments. One other question.
Yeah, I was misinformed.
Yeah, no, it doesn't. It's I'm sorry. It's that, I don't know, when I first joined the agency, I had that three-legged stool talk. Do they still give the three-legged stool talk? Your FERS is based upon a three-legged stool, Social Security, FERS, TSP, right? So if you retire at 56 or prior to your 60, your Social Security retirement age, then your stool now only has two legs. So you're kind of wobbling. So OPM says, well, we don't want people falling over, so we're going to put that leg there for them until they're eligible for that Social Security retirement. Of course, it stops at 62 whether you take your thing or not, but yeah, it's from two different pots of money. It's not affected, no ma'am. You had a question?
Okay.
Yes, ma'am.
Yes, I'm SSRS, and when I retire, I will be of retirement age. I have 17 quarters in Social Security. If I go back to work, is there any penalty?
So you have 17 quarters now.
Yeah, I
Y'all
don't
help me
plan-
with the math. That's
Well,
what.
I don't have the quarters put in to collect.
Right, but you
but
plan to
I-
go back and work and get those quarters?
But, well, yes, but if I go back to work
Uh-huh.
because I'm of age, is there any penalty for me?
Oh, we appreciate
mean-
you. You're paying into the trust fund.
Okay, thank you.
But if you're SSRS, that's the thing. If you only have 17 quarters, what's that? 23 to get 40. 23 more quarters. You can only do 4 years. That's 5 and some change years you'd have to work, and still we're going to offset you because you're getting that non-covered pension. So again, go to work, please, because we need those FICA taxes withheld, but
Is there a limitation on the amount you can make?
there's no.
No.
If you're already, if you're not yet receiving a benefit from us, then we have no concern about your earnings. It's only once you start receiving a benefit from us that there is an earnings limit. So if you're not eligible for a benefit from us, you can please earn as much as you can and pay those
Thank you.
FICA taxes. All right. Well, if there are no more questions, I thank you all so much for your time.
Yeah, before you leave, come down here.
Oh,
ma'am.
sure.
Remember, we got Medicare starting at 11 o'clock, so just go out to the table, sign in, and get your Medicare package. But before you leave, thank you so much for coming out. And we just want to present you with this certificate of appreciation for supporting our Financial Literacy Month and teaching us about educating our employees on Social Security. Thank you so much. Yeah. She did an awesome job. Give her a round. Thank you. Okay, it starts back at 11, Medicare.
Is that a new package they're gonna put out here?
Yep. Good morning. We're going to go ahead and get started. We don't want to cut into Mr. Santana's presentation time. So again, thank you for supporting our Financial Literacy Month. And today we have Mr. David Santana from Medicare. And so, Mr. Santana, I'll turn it over to you. Okay.
Thank you, Phyllis, and good morning and welcome everyone. Thank you so much for taking time out of your busy schedule to spend a few minutes with us this morning to talk about our own health insurance benefits, our Federal Employee Health Benefits Program, or FEHB. I think all of these presentations are kind of designed to kind of help us prepare to have a good retirement, specifically to have retirement financial security. Now, retirement financial security cannot be achieved without good healthcare coverage. 66% of bankruptcies filed in the U.S. today are healthcare related. So the main purpose of our presentation this morning is to give you some information about your own health insurance benefit to help you make an informed choice. The majority of us, if you have been working in the government for typically for more than 5 years and you have been enrolled on the Federal Employee Health Benefits Program, we all know that we can take that benefits into retirement. And the benefits really doesn't change into retirement, not even our premiums. So we still pay the same premium while we still working and into retirement when we take that health insurance into retirement. So for the most part, our health insurance works great for the majority of us. So why do we need to know about Medicare? So Medicare is one of the health insurance choices that we have as we become eligible for Medicare. So why do we need to worry about that? We wanted to maximize the choices we have. It is all about maximizing the choices you have. It's like anything else. You go into the store to buy a product, and if you have coupons that you can use and save and buy it in the different places, save, it is about maximizing your purchasing power. So again, our presentation is just mentioning the type of choices that we have and how we can go about maximizing your choices, and again, improve retirement financial security at the end of it all. So a few sessions that we have through this presentation. The first session is Medicare program basics. We can't really make an informed choice unless you know what you're choosing, right? So we're going to tell you a little bit about what is Medicare. What can you expect from Medicare? What kind of coverage you can expect from Medicare? It is important for us to know what we can get out of Medicare, not just what Medicare costs, but what benefits it will provide to us in addition to our FEHB plan. So we're going to learn about Medicare, the benefits, and of course, the cost of the Medicare program. Once we have that information, then we're going to learn how individuals get enrolled in Medicare. Enrolling in Medicare at the right time have financial consequences. If you don't enroll in Medicare when the opportunity comes and you try to enroll later, there are financial consequences to it. Late enrollment penalties and so forth that we're going to learn about today. And the question we all have, again, we can take our health insurance into retirement, so should I enroll in Medicare? So I hope with the information that I'll give you today, I'll help you make that determination whether you should enroll in Medicare, what parts of Medicare are important for you to consider, and which part is not going to add value to your health insurance. So diving right into Medicare, I think the majority of us have a general understanding of what is Medicare. So Medicare is a federal health insurance program for people who turn 65 years of age. The majority of individuals in the U.S. that turn 65 years of age qualify for Medicare. Those who worked and paid into the Social Security system typically are entitled to get Medicare, specifically hospital insurance, for free, and we will go into details later. Those who did not work in the U.S., do not have the required amount of working credits, can still enroll in Medicare at age 65 if they meet a certain condition, but they do have to pay for Medicare. So in 1972, the Social Security Act was expanded to include 2 additional group of people to the Medicare program. Those are individuals who are under 65 and apply for Social Security disability benefits. And I think the rep from Social Security previously probably explained how you qualify for Social Security disability benefits. If you do qualify for those benefits and you're under 65, 2 years later, you get automatically enrolled in Medicare. The third group of individuals is those at any age who developed end-stage renal disease. That is, individuals that require either kidney dialysis or kidney transplant to maintain life. We do have many infants and children, thousands of them, enrolled in the Medicare program because they develop end-stage renal disease. So those are the 3 group of individuals that qualify for Medicare. Today we're going to focus more on individuals who age into Medicare at age 65. So probably the representative for Social Security mentioned a little bit about Medicare during her presentation. That is because Social Security is the gate to Medicare. So your first stop to enroll in Medicare is the Social Security Administration. Depends on how you're going to apply for benefits and you're going to enroll in Medicare. You could either do it through the website, you could call Social Security, or you could go to one of the field offices in person and enroll in Medicare. Now, once you enroll in Medicare, overnight that information go to the Centers for Medicare and Medicaid Services, which is the agency that I represent. We are an operating division under the Department of Health and Human Services. So again, from that point forward, your information go to Medicare, and then you don't, for anything else, you don't really go to Social Security to solve any problems about Medicare unless it's actually an enrollment issue. So that's how, it's kind of in a nutshell what is Medicare and how you can get into Medicare. So I think the part that confuses us the most are when we start talking about the parts of Medicare. Part A, Part B, Part C, Part D, what those parts are and how those parts will work with our FEHB plan. The easiest way to explain what Medicare is and how it's structured is by looking at our own health insurance, our FEHB plan. Like you have this card that you seamlessly use this card as you move through from healthcare setting to setting. For example, you go to the hospital, you present your card. You go to the doctor, you present your card. You go to the pharmacy, you present your card. So those are the 3 main components of the health insurance: hospital, medical, and prescription drugs. No difference with Medicare. It does have those 3 components: hospital Part A, medical Part B, and prescription drug Part D. So those are the main components of Medicare. That's how Medicare is basically a structure, just the same as our health insurance. The only difference is that those are separate parts. Like in Medicare, they separate hospital, medical, and prescription drug into parts. And the way it is Medicare, those parts are financed. So again, when you think about your health insurance, think about Medicare. Hospital is Part A, medical Part B, and prescription drug is Part D. Those are basically the 3 main parts of Medicare, and that's what each part actually means. Now, when the individual enrolled in Medicare, they have coverage choices. They either just stay in that original Medicare that comprises hospital, medical, and typically prescription drugs, or they can choose to have their Medicare administered by a private health insurance company. pretty much the same thing that we have. We do have a private health insurance company that administer our care. No difference with Medicare. If you like to have a private health insurance company just like the one we have with Medicare, you have that choice, and we call that choice a Medicare Advantage plan. Now, if we already have that option, why do we even need to learn about Medicare Advantage plan? Well, they may be advantage for us to think about what can we get out of the Medicare Advantage plan. How do those plans are similar or different from our FEHB that may make one of these plans a good choice for us? I'm hoping to give you just a little bit of more information as we move through the presentation to help you understand a little bit more about Medicare Advantage plan and why it's important for us to know a little bit about those plans. Again, it's about maximizing your benefits, and enrolling in one of these plans may be a way of you maximizing your choices and your benefits. So as I mentioned, the typical individual that enrolled in Medicare, they will have the hospital Part A, the medical Part B. There are other two components in there, which is the prescription drugs. That means that the typical individual in Medicare that enrolling in hospital Part A and medical Part B, if they want prescription drug benefits when they go to the pharmacy to purchase a drug that was prescribed, they have to enroll in a private plan that pay for prescription drugs. So that's what Part D means. Also, the typical individual in Medicare may look into buying a supplemental plan. That is to supplement Medicare. Later on, we'll learn what Medicare covered and what it cost. And you will understand why the typical individual in Medicare will look to buy a supplemental plan. So these two parts right here, Medicare Part D and supplemental plan, that is what our FEHB plan will take the part right here. So if you have Medicare Part A, Part B, your FEHB plan will pay for prescription drugs as well as supplement Medicare. That means that, you know, when you look at this chart right here and you see that basically the FEHB fills this part right here, Part D and supplemental plan, that means that you probably will not get any additional or add any additional value to your health insurance coverage by enrolling in a separate prescription drug plan or even buying a Medicare supplemental policy, because again, your FEHB plan will take the role of paying for prescription drug as well as supplementing Medicare. Now, when we think about Medicare, as I mentioned, if you worked and paid into the system, you get Medicare hospital insurance free of premium. So you don't pay premium for Medicare Part A. 99% of people that qualify for Medicare don't pay for Medicare Part A premium. All of you basically sitting in this room and all of you listening, Medicare hospital insurance Part A is premium free. So when you think about when you turn 65 and enrolling in Medicare, that probably will be the first indication that enrolling in Medicare Part A may be a good choice when you turn 65, and this is whether you're working or retired. Now, what can you expect to get from Medicare Part A? Medicare Part A, when you become an inpatient in the hospital, they pay for pretty much everything that happens in the hospital. You know, room and board, general nursing, medications that you get in the hospital, tests that you get in the hospital, everything is covered there. Another two basic benefits of Medicare Part A are skilled nursing facility care. This is a care that an individual need that can only be provided in an institution. It's a lower level of care that you are not required to be inpatient in a hospital, but you require an intensive care that cannot be provided at home. So Medicare Part A do pay for skilled nursing facility care, rehabilitation care in the facility when you leave the hospital. If you get a knee replacement, if you get a hip replacement, if you have a condition that needs to be monitored when you leave the hospital for a certain amount of time, Medicare Part A pays for it, as well as home health care services. Now, when you look at your own FEHB plan, whatever plan you have, look for a skilled nursing facility care. Look at the brochure and see what your FEHB plan pay with regards to skilled nursing facility care and home health care. You would probably see in there that those services are very limited or perhaps not even existent with your FEHB plan. So don't look at Medicare just at what Medicare costs, but also the additional benefits that you will get under Medicare that you may not otherwise get under your FEHB plan. Question?
So I just enrolled in Medicare, and so I'm also covered under my federal insurance I have here working. So if I needed to go to the hospital for some reason, and the doctor I use operates out of a hospital that has private rooms, I noticed that the slide said it would only provide for semi-private rooms.
Right.
How would that work?
So if you go into, well, right now, because I assume that you're currently working.
Mm-hmm.
Okay, you're currently working, so your FEHB plan would be your primary health insurance for as long as you're still employed and covered under the FEHB, and Medicare is secondary policy.
Okay.
So once your FEHB plan processed and paid that claim, typically what's left behind for you after the process of the claim is the deductible. You have a hospital deductible, and there may be co-payments here and there. That will go, once they process that claim, it goes automatically to Medicare, and then Medicare processes that claim and then determine how much to help you. Typically, they will help you pay for that deductible that you would otherwise have to pay out of pocket when Medicare is your secondary policy. When you look at Medicare with regards to paying for semi-private room or private room, we'll look at why you are in a private room. Is it because there was no semi-private room in the hospital? Is it because your condition require you to be in a private room? So we look at several things before we determine. So there are instances that we will pay for the cost of a private room in the event that there is no semi-private room or your condition require you to be in a private room.
Okay, but it would, as long as I'm working full-time, it would go by what my insurance covers. And then when I stop working full-time, it'd go by what Medicare covers first. And then if I keep my health insurance as a supplemental plan, that would kick in.
Right, so after you retired,
Yeah.
Medicare will kick in as your primary payer.
Mm-hmm.
If that same thing happens, that you go into the hospital, the claim will come to Medicare first. We'll evaluate, we see how much we paid, and then the claim will go to your FEHB plan for secondary payment. And between Medicare and your FEHB, they don't really change based on primary or secondary what they paid or don't pay.
Mm-hmm.
So our policies will remain the same. Medicare will have a set of rules that we will pay for certain things, and FEHB will have this set of rules that they may pay for certain things that Medicare doesn't pay. So that will not change. So let's say you go and your plan does approve a private room, but Medicare say we're not paying the private room. Whatever Medicare left behind is it goes to your plan, and then your plan evaluate based on what they paid for. And that's how the claims are going to compensate between one insurance and the other.
Okay.
For example, a skilled nursing facility. I mean, we do pay skilled nursing facility up to 100 days. Your plan usually typically only pay for 20 days. So Medicare is your primary or secondary will still pay that 100 days of a skilled nursing facility, while your plan may only help you for 20 days.
And that's why it's important to have the supplemental once you retire.
For us as federal employees,
Yeah.
our FEHB is our supplemental plan
Yeah.
once you retire.
Yeah.
So that's why it's important for those who don't have the options we have to
Yeah.
purchase a supplemental plan.
Okay, thank you.
You're welcome. So all of that is wonderful when we see that Medicare Part A is premium free, and then we see all those benefits on the previous slides, and we start thinking about what we're paying for our FEHB plans, right? We thinking about our premium, and there's no premium for Medicare. So for those of us who start thinking, well, why wouldn't I leave my FEHB and go just straight into Medicare so I can save all that money in premium? So Medicare is not an all-inclusive program. You can see that we don't pay 100%, and depends on in the medical event that you have and how long you stayed in the hospital is how much you need to pay. If you have a longer medical stay that requires you to be in the hospital for longer than 3 months, Medicare Part A stops. If you stay in a hospital and skilled nursing facility without leaving that facility for at least 2 months and coming back, we will stop paying. You fall in what we call it lifetime reserve days, and we give you an additional 2 months that you can use, but after you use those 2 additional months, then Medicare stops. So the typical hospital stay, 3 days hospital stay is about $30,000. So you can see that just having Medicare, and if you have a longer stay in the hospital that go beyond what Medicare pays, you can be left in a hospital on your own. So another reason why we need our FEHB there, or if you don't have an FEHB, you need to look into a supplemental plan, because you could be left in the hospital without coverage. And again, with the 3 days average hospital stay cost of $30,000, you can see that, being in a hospital for a month or 2 months or 3 months on your own, that could put you in a pretty precarious financial situation, drain your savings and so forth. So that is, again, an important part of the Medicare program. Another part here is that we need to understand that our health insurance plan have maximum out-of-pocket protection, or also what we call catastrophic protection. I don't know how many of you are familiar with this terminology, but what it does is that the concept is that if we have health insurance, we shouldn't go bankrupt, right? So we are expected to pay a certain amount of money out of pocket before the plan comes in and pay at 100% for the rest of that year. Our maximum out-of-pocket protection for an individual range between $5,000 and $7,000, depends on whether you go to a network provider or out-of-network provider. For self plus one or family coverage, go between $10,000 and $14,000. That is what we are expected to pay maximum in a year before our plan kicks in and pay 100% of the cost for the rest of that year. So keep that in mind when you're making healthcare coverage choices, including Medicare. We do have that maximum out-of-pocket protection. That means that typically we will not go bankrupt unless you are receiving services that are not covered by the plans and so forth, such as staying in a skilled nursing facility care for too long, that you will run out of your benefits with FEHB. That's not considered part of your maximum out-of-pocket protection. If you need home health care services that are prolonged in time, and our plan only cover for 10 home health care visits, that money that you pay beyond that is not considered part of your maximum out-of-pocket protection. That means that it could become really costly to just have your FEHB plan if you need certain services that are not covered by our plan. So with Medicare, there is no maximum out-of-pocket protection. You can see that you can run out of the services that we have. So that's why it's important to have both insurance to compensate one another, and you have a more comprehensive package of benefits.
Quick question here. None of us probably don't have this answer yet, but we keep hearing how Congress has been looking at this and trying to say we want to turn it into a voucher instead of paying like they're paying out now. Have y'all been told anything about that other than what we've been hearing on the news and reading in the newspaper?
We haven't told anything. There is no plan whatsoever to turn Medicare into a voucher. I think what we have seen this year and the previous year is we are giving more flexibility to the Medicare Advantage plans, so those private plans, to be more innovative in the way they provide care to people with Medicare, like offering additional services beyond what Medicare pays for. You know, you probably heard about the fitness services that these plans may be paying for your fitness membership, to go and take classes, to enroll in services in the community and pay for, to pay for transportation. You know, if you need transportation to go to the grocery store, if you need some modifications in your home to make you more able to move around their home and be more independent. So what we're seeing for the past 2 years is our agency giving those plans more flexibility to offer more services to people in Medicare to help them stay healthier, as opposed to, you know, going to an institution to receive care, trying to help them stay at home, and providing a group of services at home. So that's what we have been seeing over the past 2 years, giving more flexibility to the private plans, but not turning Medicare into a voucher. So we talked again, Medicare goes up to 100 days with a skilled nursing facility. I wanted to make sure that we talked about the benefits that you get under Medicare on both programs, and again, how both programs compensate. So how about Medicare Part B? So Medicare Part B also comes with the large amount of services. More importantly, home health care services. Again, those services are paid for by Medicare. Like if you need physical therapy, occupational therapy, speech language pathologies, whatever the case may be, Medicare pays unlimited amount of home health care services that you may need. And not just that you had a hip replacement and you need some physical therapy, but if you have a stiffness in your muscles, or if you have a debilitating condition that you need an ongoing need for physical therapy, what we call maintenance therapy, not that they will help you regain your mobility, but to help you stay mobile. And that's what we call maintenance therapy that could go on for a very long time. Those services are very costly. Medicare pays for those services indefinite, and that costs zero to the individual. So again, look at Medicare Part B as what additional benefits you will get from Medicare that otherwise are not available under FEHB, that may end up adding much more value to our health insurance coverage for the longer time. And again, the majority of us, as we age, if you want to live a life with more quality, and of course being financially secure, we wanted to make sure that we're receiving the services that are available to us to help us live longer, healthier lives. And those basically, again, all of these services are preventive services that are covered by Medicare, and the majority of all these preventive services are offering to people at zero cost if you have enrolled in Medicare Part B. Now, so those are the wonderful news about all the type of benefits that you get under Medicare Part B, specifically those that are not available or limited under FEHB. So how much Medicare Part B cost? I mentioned before that the majority of us are entitled to Medicare Part A premium free. So that helps us make the choice, or that help us with choosing Medicare Part A when we think about cost. Now, Medicare Part B has a deductible. It's $185. Thereafter, Medicare typically pays 80%, and the individual is responsible for 20%. With us, if Medicare Part B is the primary, that $185 and the 20% copayment under Medicare is covered by our FEHB plan. Now, let's talk about premium. This is the part that the majority of us when we hit this, is when we start thinking, okay, is this really a good choice for me? How much value this is gonna offer to me with the money that I have to pay? So Medicare Part B premium is based on your modified adjusted gross income based how you file in your taxes, whether individual or joint tax filer. As you can see, if you are an individual tax filer and you're making more than $85,000, or a joint tax filer and making more than $170,000, you will pay a bit more on your Medicare Part B premium. So this year, the Medicare Part B premium is $135.50 for 94% of people in Medicare. There is a 6% of individuals who fall under these categories, about 85,000 and above 170,000. So depends how you, where your income falls between these thresholds is how much Medicare Part B premium you will pay. So you're thinking about the basic premium is about $1,600 a year. Even if you are down here that you are making more than $500,000 as an individual, or $750,000 as a joint tax filer, is still Medicare helps you with some. So it's about it goes from $1,600 to $5,500 a year for an individual in Medicare. Now, another thing to keep in mind is that Medicare doesn't have family coverage. So each and every one of us will have to pay that premium separate. So if you're talking about a married couple, that will pay the basic premium, that is about, what is that, about $3,000, more than $3,000 a year in premiums. Down here is much more. So again, think about those amount of money from $1,600 to $5,500. Think about what I said about your catastrophic protection with your FEHB. If you're an individual, you typically are expected to pay between $5,000 and $7,000. If you fall within this category, of course, our maximum out-of-pocket protection is much more than $1,600, and it's about equal to the maximum out-of-pocket protection here, even if you are above these income brackets down here. So also think about what you get from Medicare that you don't get from your FEHB. For example, if you need physical therapy, occupational therapies, that the plans have very limited coverage for that. If you need physical therapy, for example, you need that kind of service for a longer period of time, you are much likely to benefit from Medicare for enrolling in Medicare Part B, even if you have to pay this high premium just by comparing the dollar amount. So again, look at Medicare Part B, not much about what it's going to cost you, but also the additional benefits that you may get by enrolling in Medicare Part B. If you look at the previous year, you and your spouse, and you see that your out-of-pocket expenses for the previous year between the two of you are $500, $700, $1,000, you say that's really, if I have to pay this much on Medicare, like for a married couple that will have to pay $10,000 in Medicare Part B premiums, and then you look back and you say, but I only spending $500 a year. Why would I pay $10,000 to be enrolled in Medicare Part B? So again, it is a cost analysis that we have to make when we come to terms with enrolling in Medicare Part B or not. So if you fall into that category, and between you and your spouse have to pay $10,000 a year Medicare Part B premium, look at how much you're spending when you're FEHB and say, I'm not sure when my maximum out-of-pocket with FEHB is $5,000. It doesn't look that Medicare Part B is going to do much for me other than having that additional expense to enroll in Medicare Part B. That's because you feel healthy. Now, typically what happens is As we age, then those services are starting to pour in, and then we start seeing that our maximum, our out-of-pocket expenses start increasing more and more. What can you do if that's the case? Let's say you are really very healthy at the moment and you really don't see the additional value that I am explaining about Medicare Part B, but later on you need those services. You could always go back and enroll in Medicare, and we'll talk about when to enroll in Medicare in a little bit. But again, I wanted to break the dollar amounts a little bit further because I'm giving you the information about all the benefits that comes with the both programs, but at the same time, you really need to look at the cost, because if you are under those brackets and you have to spend that much between you and your spouse, you know, all of the wonderful things that I'm saying about Medicare Part B may not add value to your health insurance other than the additional expense if you have to pay those higher premiums. Questions?
I want to make sure I understand on the chart where it says that it's based on your yearly income in 2017 for what you pay in 2019. So if you were working full-time in 2017, but then you retire in 2018, so your income's going to drop pretty drastically. The premium you pay in 2019 is still going to be based on what you were earning in 2017 when you worked full-time? Is that correct?
Correct. That's a great question. So how does Social Security go about determining your Medicare Part B premium? So let's say, you know, it's, you know, this is May. You go and 2019. You go and enroll in Medicare tomorrow. And the last year, you know, you're turning 65 now. You retire, you know, in 2017, at the end of 2017. When you file your taxes last year for 2017, you were still full-time employed, right? So your income was much higher. Mm-hmm. So when you enroll now, Social Security will share your Social Security number with the IRS. The IRS is going to be looking at the taxes that you filed last year for the year before. Now, once they see that you fall above this income threshold, the IRS will return that information to Social Security and say, you know, these individuals modified adjusted gross income, you know, in 2017 was $270,000. Well, it was above $270,000, and Social Security will send you a letter saying, I'm looking at these numbers. Let's say that you were above $170,000. Mm-hmm. They're going to send you a letter and they say, you know, based on your income that you reported to Social Security, your Medicare Part B premium will be $270. So when you see that letter, the first thing you're going to say is like, okay, I'm retired now. That's not the case. Mm-hmm. So in that letter, they have a list of life-changing events. That will be, one of them is actually retiring, is a life-changing event. They have other things in there like, you know, you divorce, you know, your spouse passed away, whatever the case may be, that you no longer, that's not longer your current situation. So they give you instructions in terms of what to do to make sure that you pay the proper premium. So if you fall, you know, maybe below 85,000, and you just send that information to Social Security and they will readjust your premium to your current situation.
Okay, thank you.
So that is basically about coverage and cost. So let's take a quick look and see how people enrolled in Medicare. So I mentioned before about those individuals that apply for Social Security retirement benefits and they are under 65. If they do, 2 years later, after they start getting cash benefits, they will be automatically enrolled in Medicare. Probably the Social Security rep also mentioned that you can apply for Social Security retirement benefits as early as age 62. If you did apply for Social Security benefits or planning to apply for Social Security benefits before you turn 65, 3 months before your 65th birthday, you will receive a welcome package from Medicare, indicating that you have been automatically enrolled in both Medicare Part A and B, and it'll ask you that if you, for example, are currently working, whatever the case may be, if you want to keep Medicare Part B. That is because Medicare Part B, everyone that enrolled has to pay a premium. We didn't pay taxes to earn free Medicare Part B. So it is our choice to enroll, and if we do enroll, we keep Medicare Part B, we do have to pay that Medicare Part B premium. So again, if you're actively working, you don't want Part B at that time, you can decline it if you get automatically enrolled. Civil service retirement annuitants will not get automatically enrolled in Medicare, so they have to do it on their own. When can you enroll in Medicare? This is the part that I mentioned in the beginning that comes with time and financial consequences, and if you don't enroll in Medicare when we give you the opportunity to do so. So, and here is, if I'm not automatically enrolled, when can I enroll in Medicare Part B? Why do you think I didn't put Part A in there? One said it's automatic. It's automatic if you were getting Social Security retirement benefits, right? But if you were not getting Social Security retirement benefits, Part A is not automatic. That means that you have to enroll. Anyone else, why do you think Medicare Part A is not here? What did I say about Medicare Part A? The first thing, in terms of cost, it's free because you're entitled, because you pay into the system. So it is free, you're entitled, you pay into the system, you enroll in Medicare Part A whenever. There is no late enrollment. After you turn 65, you can choose to enroll in Medicare Part A at any time. It's free, you earn it. There's no enrollment time frame. Medicare Part B is actually the part that we need to think about because we're not entitled to this part. Federal employees, as of today, are the only one out there that have the choice not to enroll in Medicare Part B when we retired. We're the only one. Anyone else that worked from any other company out there, when they retired, they are required to enroll in Medicare Part B. Even TRICARE for military retirees and family members. Even the CHAM VA benefits that comes from the VA, they're required to enroll in Medicare Part B in order to keep their benefits. We as federal employees with FEHB plans are not required to enroll in Medicare Part B when you retired. Yes.
My wife has left the government to raise our child, and she's planning to come back when she gets a certain age. Now, if she reached that age at 65 and she hasn't come back, then she is required to go ahead and sign up then, or what?
Is she under your policy?
Right now, she's on my insurance policy, yeah.
Right, so and you're actively working.
Yeah.
So for as long as you're actively working, she is protected. She doesn't need to enroll in Medicare Part B when she turns 65, for as long as she's under your policy.
Okay.
If she returned to the federal workforce,
yeah,
and re-enroll in FEHB, and you end up retiring, that same thing applies. She doesn't need to enroll in Medicare Part B.
Okay, thank you.
You're welcome. So so again, it is our choice to enroll in Medicare Part B. You don't have to. Your FEHB plan, if you were 65 and retired, if you don't enroll in Medicare Part B, your FEHB plan is going to keep functioning just the way it is right now. Nothing will change. You may read on the FEHB plan brochure, if you go to section 9 on your in whatever plan you have, Section 9 has information about Medicare and FEHB. You probably will see a little square in there saying when you turn 65 and you're retired, if you don't enroll in Medicare Part B, your FEHB plan will reimburse hospital and physicians the same rate that they would get under Medicare. Now, don't get confused by that statement. It just basically means that the law, there's a federal law that says that once you're over 65 and you're retired, if you don't enroll in Medicare Part B, the physicians are going to get the same rate that they will get if you were enrolled in Medicare. How would that impact you? You may have to pay less out of pocket. That's all. But this will be a seamless thing that will happen in the background. You know, a service that you may had to pay like $40 co-payment, maybe when you turn 65, you may only have to pay $20 for and instead of $40, because let's say that the service was for $100 and the physician, the Medicare approved amount was $100 and they get $80. You can only be billed $20, not the $40 co-payment. So again, don't get confused by that statement. It just basically means that if you don't enroll in Medicare Part B, the physicians are going to still get the Medicare, what they would get if you were enrolled in Medicare. Yes.
Okay. So in this scenario, so you said us as federal employees, we are not required to enroll in Part B. We're the only ones that are not required.
Correct.
Is that right? So if you have like a couple and the husband's full-time, the wife's part-time, and they're both covered under his private policy through his employer, and she retires and she's enrolled in Medicare Part A, are you saying then that can she continue to be covered under his, or when she retires, does she have to get Part B?
Right. So you always look at the policy holder.
Okay.
What's the policy holder doing? The individual that is holding the policy. If that policy holder actively working, whether it's working for the federal government or for a private company outside of the government, whomever that is, if that policy holder is actively working. If it's actively working, there's no requirement to enroll in Medicare Part B at age 65 while they're actively working.
Okay.
What is different is that when you retired in the government and you have FEHB plan, you are not required to enroll in Medicare Part B. But if you retire in the private sector, you will be required to enroll in Medicare Part B upon retirement, or else you typically lose your benefits.
But that's, in the scenario I gave, it would be the retirement of the husband that has the plan, not the wife who's covered under the plan.
Right, so let's say your husband is working for the private sector.
Yeah.
Let's say you are insured by him.
Right.
He has a policy through his private sector. You're working for the government, but you don't have FEHB plan because you're covered under him.
Right.
Whatever he does is going to affect you.
Okay.
Like when he retired, even though you're working for the federal government, you are not covered by the FEHB.
Okay.
So once he retired, you're going to have to apply for Medicare, even though you're actively working, because his plan most likely will require you to enroll in Medicare Part B after he retires.
Yeah.
So that is the difference between federal government health benefits and outside of the government.
Okay, thanks.
So again, you have 7 months to enroll in Medicare Part B when you turn 65. That is what we call your initial enrollment period. So what happens if you miss that initial enrollment period? Every year from January through the end of March, you can come back and enroll in Medicare Part B. So remember what I was mentioning before. Let's say at the moment you don't need Medicare Part B, but later on you may need it. And of course you have an opportunity to come back to Medicare Part B. The only thing is that you will be penalized 10% for each year that went by and you could have been enrolled but decided not to enroll in Medicare Part B. So if you waited 5 years, it's 50% penalty. If you waited 10 years, it's 100% penalty. and it goes on. The penalty is based on whatever premium is that year. So if you pay a 10% penalty, this year is going to be 10% on 135.50. If 10 years from now Medicare Part B premium is $500, you will be paying 10% on that $500. So although the percentage will not increase, the premium itself or the penalty will increase because it's based on the premium that year. So it increases year after year, and that penalty will remain in there for years to come. It will never go away. So that is to say that not enrolling in Medicare Part B in the beginning after you retire, it makes a lot of sense in the examples that I was giving if you're pretty healthy. But, as years go by, that penalty accumulates, and the money that you may have saved in the beginning by not enrolling in Medicare Part B, you may have to pay a penalty later on if you decide to enroll in Medicare Part B at a later time. And again, that penalty will stay there for as long as you are enrolled in Medicare. Exceptions to the rule, what we were just talking about. For as long as you're actively working, for you and your spouse, if your spouse is covered under your policy, you don't have to enroll in Medicare Part B. That is because you fall under the exception or the special enrollment period that we gave you, that for as long as you're actively working and your FEHB plan is your primary health insurance, you do not need to think about enrolling in Medicare Part B. When you retired, we give you 8 months to think about enrolling in Medicare Part B and whether that is a good option for you. So again, think about postponing Medicare Part B, and think about the penalty that comes if you later on do need to enroll in Medicare Part B because your out-of-pocket expenses are starting to become astronomical. Another thing to know about this enrollment right here, with when you enroll late, although you can sign up for Medicare between January and the end of March, Medicare will not become effective until July of that year. So let's say you are in a skilled nursing facility and you wanted to apply for Medicare right away between those time frames. It doesn't mean that Medicare will kick in right away. You do have to wait 3 to 6 months for Medicare to become effective. So far we went over Medicare Part A. So a little recap. Medicare Part A is premium free, right? We don't pay for it. Medicare Part A comes with many benefits, including skilled nursing facility, home health care, if you meet certain requirements, and many other services that comes under Medicare Part A, right? That kind of makes our decision easy. Medicare Part B, what did we learn about Medicare Part B? We're not entitled to Medicare Part B. If we want it, we have to sign up for it, and we have to pay a premium. The premium is going to depend on how much money we make. It's kind of based on our income. What can I expect from Medicare Part B? Many services, including home health care services that are unlimited and not available under my FEHB plan. I do need to think about enrolling in Medicare Part B when Medicare gave me the opportunity to do so. If I am turning 65, I'm working, or covered under my spouse who is 65 and working, I do not need to enroll in Medicare Part B at age 65. That is because I qualify for the special enrollment period that I can sign up at a later time when I retired. Question in the back.
Hold on, let me bring the mic up back.
Sorry, let's get you a mic so we can all hear.
I just have a question on how the premium is paid. Is that just deducted from your Social Security payment, or is that something separate?
Great question. How your Medicare Part B premium is paid. If you're getting a Social Security retirement check and it's enough to cover your premium, Social Security will deduct it automatically. if you're getting an annuity from the government, it's going to be deducted automatically from your annuity. So again, once you sign up for Medicare, if you're not getting a Social Security check, but you're getting an annuity, the money is going to be deducted from your annuity automatically. So Social Security will send that information to OPM, and OPM will arrange for your premium to be taken out of your annuity. If you're not getting any of these benefits, either Social Security or an annuity, we'll bill you every 3 months for the Medicare Part B premium. You also have the option to have an automatically taken out of your bank account or pay out of credit card and things like that. Yes.
This is related to the previous screen. 2 questions. One is, do you, when you become this certain age, or even after you're a federal government employee and you want to enroll, do you do it on the internet or do you go in person?
So it depends. If you are applying just for Medicare Part A, you can just go.
No, not Part A, but Part B. I'm sorry.
So you wanted to sign up for Medicare Part B at a later time?
Yeah, I'm still working. I'm getting ready to retire, and I want to sign up for Part B. Or I just want to wait, and I guess you said the grace period is 8 months. My question on that is, the second question is, are you penalized after the first 3 months if you don't sign up in that pay period? So how do we get eight months the opportunity to sign up with Part B? Because we're federal government employees, question mark.
Right. So when you turn 65, you fall in that initial enrollment period. 3 months before your birthday, the month, and 3 months after your birthday. That's your initial enrollment period. That will never change. That's it. After that, if let's say you turn 65, you wait until you're 70 to retire 5 years later. And then we'll give you 8 months at that time to sign up for Medicare Part B. How we will calculate at that time? Well, you have been employed ever since, you went through your initial enrollment period up until the point that you retire. For as long as you're doing within those 8 months, there is no waiting, there is no penalty. So if you signed up this month, Medicare Part B will start the following month. So no waiting, no penalty.
The other question is, I'm still working in everything. I got a package in the mail, and I'm eerie to even do anything with stuff that's come in the mail now. That's because we get all these crazy phone calls, and want me to fill it out to apply for Medicare. I don't believe y'all don't send out package in the mail, do you? Okay. All right.
Did you already enroll in Medicare Part A?
No, I'm already in Part A, but this is for Part B.
Okay, so if you are just enrolled in Medicare Part A and not Part B, because, for example, you're actively working,
right?
Every year we do send a letter reminding you about Medicare Part B.
Oh, this is an application
for Medicare Part B.
Part A, I think it may be Part B. I have to go back.
It may be for Medicare Part B. That would just basically remind you that if you wanted to sign up for Medicare Part B, here's an application, but. It's just a reminder. You don't have to sign up.
Okay, I just want to know
a reminder.
If it's somebody else doing something they shouldn't be doing out there and they're using Medicaid, that's why I asked the question.
No, if the mail comes from the U.S. Department of Health and Human Service, look at the envelope.
Okay.
If it comes from the U.S. Department of Health and Human Service and the letterhead says U.S. Department of Health and Human Service, it is an official government mail.
I thought this was part of the Social Security thing, package, okay.
Right, so no, this
Health and Human Services.
This will not be part of Social Security. Okay. This letter that you're getting, it will come from the Department of Health and Human Service.
All right, thank you.
You're welcome. All right, so I think we're gonna go on real quick, and with that information, I was just doing a recap so that we can run through our choices now real quick. So I think everyone is clear about Medicare Part A. When you turn 65, whether you're working or retired, what should you do about Medicare Part A? What should you do when you turn 65? It's premium free. Like the gentleman Joe was just mentioning. He has Medicare Part A already. It is premium free. Whether you're working or retired, when you turn 65, I would enroll in Medicare Part A. Even if my FEHB plan is primary, there could be a hospital bill that I may be responsible for deductible or something else that Medicare Part A could help me for. The only instance that we would advise individuals not to sign up for Part A at age 65 is, for example, if they have a health savings account. That means that you have a high deductible health insurance plan, FEHB, and you're enrolled in a health savings account. Not to be confused with the flexible spending account. Health savings accounts is different, and if you enroll in Medicare Part A, you will not longer be able to contribute to the health savings account when you enroll in Medicare Part A. So that's why we say if you're actively working, you have a health savings account, and you wanted to keep contributing, then I will delay enrollment in Part A until I retired, so I can keep contributing to that account. Yes.
Will you receive a package from Health and Human Services to enroll in Medicare Part A as well?
Great question. So would you receive a package to enroll in Medicare Part A at age 65? The answer is no. You would only be advised at a later time, like after you picked up Medicare Part A, every year, as he mentioned, we send a package during that first 3 months of the year, reminding you that this is the time to enroll in Medicare Part B if you want to be enrolled in Part B. But Part A, the first opportunity to enroll, we will not send anything out. So now you know because you come to this seminar, but the majority of people out there will not know to enroll in Medicare Part A at age 65. That's a good question. So I think the big question is about Medicare Part B, and we just went over the options. If you're actively working, do you need to be enrolled in Medicare Part B? The answer is no. Enrolling in Medicare Part B while you're actively working is not going to add any value to your policy because Medicare will be your secondary policy. After your FEHB process and pay your doctor claims, there is very little left behind for Medicare Part B to help you with. Unless, of course, as we mentioned before, you are getting an intense package of physical therapy, occupational therapy, things like that your plan may not be paying. It may be a good idea to enroll in Medicare Part B in that case. But other than that, it's typically not going to add additional value to your policy to enroll while you're actively working. And we also mentioned that you qualify for a special enrollment period. So once you retired, during that 8 months, if you wanted to sign up for Medicare, there is a form that is downloadable from the website. The forms only have two little parts, a one-page form. The one part says, your name, who do you work for, what was your insurance company from when to when you have that policy. And the other part is for your employer to fill it out. This person was working here, DEA, from this time to this time, and they have FEHB from here to here. It's just to tell Social Security that you qualify for a special enrollment period. Now, when you retired, this is a big question that we have to think about. When you retire, is it a good idea to sign up for Medicare Part B? Take into account, as I mentioned before, all of these benefits that comes on the Medicare Part B that you otherwise would not have with your FEHB plan. But also take into account the cost of Medicare Part B that each yourself and your spouse, it isn't an independent kind of payment system that each of you would have to pay for that premium, and see if it makes sense for you to enroll in Medicare Part B. Depends on whether you fall within that income bracket. So we'd say Medicare Part B is a good choice to have when you retire. It's just because you provide that comprehensive package of benefits that between one Medicare and your FEHB plan both compensates to provide almost a complete coverage. When you go to the doctors or to the hospital, typically what you would get if you're only enrolled in FEHB is an explanation of benefits and saying how much you're responsible to pay. When you have both programs, typically what you get is an explanation of benefits from from Medicare and your FEHB telling you, this is how much Medicare paid, this is how much we paid, you need to do nothing because it's covered between the two programs. If you have, for example, if you have TRICARE, you're going to be required to enroll in Medicare Part B at the age of 65. If you want, if you are enrolled, for example, in an HMO plan, it may be also a good idea to have Medicare because Medicare is a nationwide program. You don't need referrals to see a specialist or to go to any providers within the U.S. If you have an HMO plan, it may be a good idea for you to have Medicare because you still enjoy the freedom of going to any provider. I mentioned about Medicare Advantage plan, and I'm gonna go quickly here because I know we are up against the time. So Medicare Advantage plan, those are private options, basically the same thing that we have with our FEHB, and many of the companies offering FEHB also offers Medicare Advantage plan. The typical cost of these plans, so the average cost is about $42 a month. Now, when you compare these plans with our FEHB, the cost is going to be much lower in the Medicare Advantage plan. If you enroll in the Medicare Advantage plan, you get everything that I mentioned that you will get on the original Medicare. So they have to start by paying for everything that Medicare pays for, including home health care services, skilled nursing facility, and all these other services that Medicare pays for. If you enroll in these plans, you also have maximum out-of-pocket protection that you don't have on the original Medicare. So how do you find out about these plans and how did this apply to us? You go to Medicare.gov website, which is listed on the back of the slides. Right on the front page, you will see a link in there or a button that says Find and Compare Health Plans. You click in there and you can just do a general search by typing your zip code. You type your zip code and it'll tell you the plans that are available within your area. It'll tell you how much the plan costs and all the benefits that comes under those plans. For us federal employees, when we retire, we are also the only one who have this choice. You have the choice to suspend your FEHB plan and try out one of these Medicare Advantage plans. Let's say you type your zip code and you see a plan in there that'll cost you, $50. And you see the array of benefits, including all these fitness benefits and all these extra benefits. And you also see that they pay for everything that Medicare pays for. And you look at your plan and you say, well, I'm paying $200 a month for, or every pay period for my plan. This plan will cost me $50. I'll try it out. You can suspend your FEHB plan while trying this plan out. If it doesn't work, you can always come back to your FEHB plan during open season or if you move out of the plan service area. So for us, what this means is it is a choice that we have. Maximize your choice. Evaluate your options and see if this may be a good option for you. Try it out. For as long as it's working, you can keep this. If it doesn't work, if one day doesn't work anymore for you, your doctor doesn't participate, whatever the case may be, you could always come back to your FEHB plan. So again, it is a choice. Use it wisely.
I'll make it real quick. You just brought something very, very serious. If you retire as federal government employees and you go out there and you suspend your FEHB plan and you go into this Medicare Part B, C plan, you don't like it. How can you get back to the FEHB plan unless you are a federal government employee? I would have to come back to work and then sign up?
No. So do you hear the word that I mentioned, suspend your FEHB? Never terminate your FEHB into retirement because you won't be able to get it back. When you suspend it, it means that it's there for you. You are not paying premium, you're not using it, you're not paying premium, and OPM is not helping you with your premium. But it's there. So during the next open season, you just go back the same way that you will choose your plan, and then you can just re-enroll in the plan or another plan at that point.
Dave?
Yes.
Question. Okay, I just want to make sure that I understand this. Okay, so when I am counseling my retirees, okay, they are now retiring. Okay, so they cannot suspend their FEHB until they actually retire? They have to wait until like the next open season, or do they do that when they submit their retirement package? They can suspend their FEHB and pick up but do they have to be age 65 to do that? Yes.
So you have to be enrolled in Medicare Part A and B.
Gotcha.
And you also have to be retired.
Gotcha.
So enroll in Part A and B, that's another benefits of having Medicare Part B. So enroll in Medicare Part B, A and B, and then be retired. And then if you enroll in Medicare Advantage Plan, you just call, your benefits officer, the retirement office, and then you just request for your FEHB plan to be suspended whenever that happens.
And they have to do that through the OPM because they're now retired.
Because they're now retired, so they do have to call the retirement office and OPM and request it. So Medicare Part D real quick. I mentioned about prescription drug benefits. Each and every one of our plan brochure, the second page after the front page will have a disclaimer there saying your FEHB plan has a prescription drug benefit that is comparable or better than Medicare prescription drug plan. That's just basically letting you know that you do have a good prescription drug plan through your Federal Employee Health Benefits Program, and it is up to you to enroll in Medicare Part B or not, Part D. For as long as you have your FEHB plan, you qualify for a special enrollment period of Medicare Part D. If you at some point feel like you're paying too much on prescription drug benefits with your FEHB plan, you could always go to that website that I just mentioned, and it allows you to put the medicines that you're taking, put the list of medicine, and hit a search button there, and it'll tell you all the Medicare Part D plans that are available within your zip code and how much they cost. They could go from $12 a month to $32 a month for having these plans. If you're taking in specialty drugs that you're paying a lot of out-of-pocket expenses under your FEHB plan, you could always go and evaluate this option. Again, if you're paying too much out-of-pocket in prescription drug, this is a choice you have. And because you have FEHB plan, you can pick Medicare Part D plan at any time. You qualify for that special enrollment period. Whether you're working or retired, it doesn't matter. For as long as you have FEHB plan, you qualify for a special enrollment period. Again, maximize your benefits. If you're paying too much in prescription drug, look at these plans. They have a very comprehensive package of prescription drug plan, including specialty drugs. Those drugs that you hear in the news that they're costing $80,000 a year, those drugs are covered by these plans, and you typically are expected to pay only about 25%, if anything, under these plans. So you could save money. So don't automatically say, well, I already have prescription drug. I don't need anything else. Just look at Medicare Part D as another option that you have in the event that you're paying too much in prescription drugs. I think this got stuck. Go ahead.
The interpreters are only here till 12 o'clock. We're almost 15 minutes over. I apologize if I'm rude. But they specifically, this is how they did the contract.
Okay.
Specifically, they wanted us to cut it off at 12 o'clock. And we're almost.
Thank you. Thank you for that. And yeah, we're pretty much done with the presentation.
You're dismissed.
We're pretty much done with the presentation. If you wanted to stick around and ask more questions, but I think the last part was just basically coordination of benefits. And for as long as you're actively working, FEHB is your primary. When you retire, FEHB switch to be your secondary policy, if you have both programs. So again, that concludes our presentation, and I'll stick around for a little bit if you have additional questions, and I'll be happy to answer.
Okay, before you leave, I just want you to, we just want to present this certificate of appreciation. Thank you for so much in coming down and educating us on Medicare.
Thank you
I know
so
you had
much.
we have a lot of questions, and we appreciate you. You support us year after year, and I just want to thank you.
Thank you so much.
You're
Thank
wonderful.
you. It's always a
Thank you.
pleasure.
Yeah, okay. Okay, be back.